It was recently reported that the Trump administration is working on a new 50-year mortgage to make home ownership more affordable. President Trump himself confirmed this by posting the following image on his social media. The director of the Federal Housing Finance Agency commented on the post that this is a game changer for home ownership. That's because it has the potential to reduce the monthly average payments, making home ownership a lot more affordable to the masses. The Federal Housing Finance Agency then added that this is just one proposal among many others that they are currently working on to make home ownership more affordable. Here's what the director said. We are laser focused on ensuring the American dream for young people, and that can only happen on an economic level of home buying. A 50-year mortgage is simply a potential weapon in a wide arsenal of solutions that we're developing right now. Stay tuned. Finally, he added that they're also working on solutions to give relief to 5-year, 10-year, and 15-year mortgages. This news has led many of you to ask me how this might impact the REIT sector. Will this have a positive or negative impact on REITs? And as usual, the answer is that it depends. It varies from one property sector to another, but overall, I think that most REITs should benefit from this. Hey, this is Yossi, a small investment firm that specializes in REIT investing. In today's video, I'm going to give you a step-by-step review of how the 50-year mortgages could impact different property sectors. I'm also going to highlight some of my favorite REIT investment opportunities today, so make sure to stick till the very end. Finally, before getting started, I want to remind you that we just started a new top 5 picks for 2026 series at High Yield Landlord, which is my REIT newsletter, and you can access this series completely for free with a 2-week free trial. Moreover, if you decide to stick beyond the 2-week free trial, you will also get a big discount as part of our Black Friday sale. This offer is only available for a limited time, so if you ever thought of giving High Yield Landlord a try, now is a great time to lock in the discount with the 2-week free trial. You won't be charged anything in the first 14 days and can cancel anytime, no questions asked. Okay, the first property sector that I want to discuss are single-family rental REITs such as Invitation Homes and American Homes for Rent. These government-subsidized 50-year mortgages have the potential to make home ownership more affordable, increasing the demand for single-family homes and pushing their prices to higher levels. On one hand, this would benefit these single-family rental REITs by increasing the value of their portfolios and removing the fears of a housing market crash. Moreover, the greater demand for single-family homes would then also allow them to accelerate their external growth prospects by selling some of their stabilized properties to then reinvest that in new development projects, earning large spreads of their cost of capital. These REITs have been very successful at such capital recycling over the past years, and I think that this would only accelerate if the demand for homes increases as a result of 50-year mortgages. But it's not all positive for single-family rental REITs. Another impact of these 50-year mortgages is that this could reduce the demand from renters. This could then slow down rent growth, potentially result in lower occupancy rates. But the good news here is that occupancy rates are already historically high, rent growth is solid at 3 to 5%, and therefore even if we saw a slowdown, I would still expect rents to keep growing at a decent pace. I think that overall the net impact would be positive for single-family rental REITs, given that this would potentially increase the value of their properties, accelerate the external growth prospects, and also remove the biggest fear impacting this sector, which is that housing would crash. This has materially hurt the market sentiment in recent years, and so if you remove this fear, some of these REITs could enjoy significant upside potential. Right now, Invitation Homes, as an example, is priced at one of its lowest valuations ever, at an estimated 40% discount to its net asset value, and we think that's quite opportunistic. The second property sector that I want to discuss are self-storage REITs, and I think that this could potentially be the property sector that actually benefits the most from 50-year mortgages. Self-storage REITs like Public Storage, Extra Space Storage, CubeSmart and others have suffered in recent years due to weak demand, and this has depressed their valuations. The demand was weak because housing was unaffordable. As a result, transaction activity slowed down, people stayed put, and they simply didn't move as much. And historically, whenever people move, that's a strong demand driver for self-storage. But 50-year mortgages could potentially change this and lead to a new wave of new home buying and people moving around, which would then lead to more demand for self-storage space. I think that this could surprise the market to the upside, given that self-storage rates are today trading at near decade-low valuations due to the weak demand and slow growth. But if that now accelerates, partly as a result of 50-year mortgages, we could see valuations expand quite significantly. Hey, before I go into the third category of REITs, can you please do me a huge favor and click the like button if you enjoy this type of market updates? Thank you so much in advance. The third category of REITs that could win big here are specialty REITs like timberland REITs, farmland REITs, and land banking REITs. Timberland REITs would benefit here because if there's more demand for housing, we're likely going to build more of it. And historically, whenever there's more construction activity, there's more demand for lumber, resulting in higher commodity prices, allowing timberland REITs to harvest more of their timber, resulting in greater profits. At the same time, this may also lead to more better use conversions, with some timberland REITs selling some of their land to home builders, and typically such better use conversions have resulted in very significant upside. Rayonier, which is one of the leading timberland REITs, which we also own at High Yield Landlord, has noted that such conversion projects can lead up to 10 times higher valuations. So overall, 50-year mortgages could potentially allow timberland REITs to sell more of their land at large profits, all while harvesting more trees at higher prices. Farmland REITs like Farmland Partners and Gladstone Land could also benefit from similar better use conversions. They've done so in the past, but if we now see an acceleration in demand for home buying, we could see even more of such conversion projects, leading to more upside. Finally, the newly listed Millrose property, ticker symbol MRP, could be a huge winner here, given that it owns primarily home sites that are waiting to be sold or developed. It's a recent spin-off from the home builder Leonard, which still owns about 20% of the equity and has option contracts to gradually buy some of these home sites off Millrose. So it's essentially a land banking REIT. It's a very unique concept, it's the first of its kind, and it could win big if we now see an acceleration in demand for home ownership. The fourth property category that could benefit from 50-year mortgages are certain retail REITs. Think here of REITs like Kimco or Whitestone REIT or Kite Realty Group. These are strip center REITs that typically own neighborhood centers in growing suburbs of Sunbelt markets for the most part. And these properties are often surrounded by large single-family home communities and a lot of additional land that's already zoned for housing. Therefore, if the 50-year mortgages now lead to greater home buying, this could then lead to more construction activity, greater population density surrounding these neighborhood centers, leading to higher tenant sales and higher rents. Typically, when there is growing demand, you get more supply, and so you would expect more construction activity of these retail properties as well. However, according to a recent study by Kimco, one of the leading retail REITs, retail rents are today way too low to justify new retail construction projects. According to their study, retail rents would need to rise by about 65% to make new development projects economically feasible. Therefore, we think that this demand is unlikely to be met with new supply anytime soon, and we're likely to enjoy solid rent growth over the coming years, even ignoring this 50-year mortgage. I just think that these new policies could potentially boost that growth even further. By the way, we just recently had the chance to interview the CEO of Whitestone REIT for High Yield Landlord. This is one of our top picks in this space. It's been a big winner for us in the past, and we expect more upside going forward. You can read the interview for free, currently with the 2-week free trial. Finally, I want to discuss apartment REITs, which unfortunately I think would actually suffer from these policies. These REITs have suffered from overbuilding in recent years, and if we now get even greater subsidies for home buying, I think that this would potentially reduce the pool of renters, hurting rent growth even further, potentially leading to lower occupancy rates. This could then also further hurt the market sentiment of apartment REITs, potentially leading to some cap rate expansion, even greater discounts. So overall, this is a net negative. The good news is that the supply outlook should improve very significantly already in 2026 and even more so in 2027. So this should make up for weaker demand. This is anticipated to lead to much stronger rent growth over the coming years when compared to what we experienced in recent years. But overall, this would still be a net negative for apartment REITs in my opinion. Even then, we are still investing heavily in apartment REITs because we think that this risk factor, along with others, are more than priced into their valuations. As an example, BSR REIT is today trading at a 35% discount to its net asset value, and we actually think that its net asset value is already conservatively estimated at a roughly 5.5% cap rate. In the private market, similar properties are actually transacting at closer to a 5% cap rate right now. So taking that into account, the net asset value discount is closer to a 40-45% discount, and that's just an unbelievable deal in my opinion. Ultimately, every sector has pros and cons, and there is no bad or good sector. It simply depends on the valuation and the timing of your investment. Overall, if the government steps in to subsidize housing even more than it currently is, I think that this will benefit single-family rental REITs, self-storage REITs, timberland REITs, certain retail REITs, farmland REITs, and land banking REITs. At the same time, the biggest loser would probably be apartment REITs. As such, there are many more winners than losers, and so I would see this as a gift for REIT investors. At High Yield Landlord, we are closely tracking this new development and will adapt our portfolio accordingly. Once more, if you want to access our full portfolio as well as our new top 5 picks for 2026 series, you can join us for a 2-week free trial and get a big discount as part of Black Friday. It will be the first link in the description of this video. Thank you very much for all your support. Let me know in the comment section if you have any questions about these REITs or these new policies. I'll be happy to help. See you at my next one. Bye-bye.